Welcome back. Today we're doing a deep dive into the HighPeak Energy first quarter 2025 earnings call. We've gone through it, pulled out the important stuff.
Yep. Our goal here is really to, cut through all the jargon and give you the key insights. Basically a shortcut to understanding their performance and outlook.
Okay, so on the call, we heard from CFO Steven Tholan, President Michael Hollis, and Ryan Hightower, the VP of Business Development.
Right. And they did mention Jack wasn't there, apparently. He had a little tumble in a cutting horse competition. Sounds like he's recovering fine, though, and business as usual.
Good to hear. All right, let's start with the results. What's the snapshot for Q1 2025?
It looked pretty solid. Their average production came in over 53,000 barrels of oil equivalent per day. BOE per day.
Over 53,000. How did that compare to what people were expecting?
It actually beat both their own guidance and the consensus estimates. So, a nice surprise there.
A beat on production then. Was that a big jump from the previous quarter?
It was about a 6% increase versus Q4 last year, and importantly, they kept the oil percentage the same in that mix.
Okay, so production's up. How did that flow through to operating profit, EBITOP?
Yeah, they generated almost $200 million in EBITOP. That's up roughly 10% compared to Q4, and they did that with basically the same average oil price.
So production and EBITOP both climbing with stable prices. Margins must have been decent.
They were. They mentioned healthy cash margins, and part of that was helped by lease operating expenses actually dropping about 3% lower quarter over quarter.
Lower LOE. Nice.
Yeah, they gave a shout out to their field team for those cost savings.
And with this strong start, did they tweak their forecast for the full year at all?
They did. Because Q1 was strong, they're narrowing the full year production guidance range. They basically raised the bottom end, which pulls the midpoint up for the year.
Okay, that gives us the headlines. Now, let's dig a bit deeper. What were the main drivers they talked about on the call? How are they getting these results?
Well, one of the biggest themes was definitely operational efficiency. They seem to have found another gear in their development program.
Operational efficiencies?
Yeah.
Like where specifically?
Primarily drilling. They've really cut down their spud timing in the last couple of quarters.
Spud timing? Remind me, that's the time from showing up on location to actually starting the drill bit turning.
Exactly. And they said that average time dropped from 14 days down to about 11 days.
11 days from 14. That's quite a jump, over 20% faster.
It is. And the direct impact is they can drill more wells with the same rig, over 30 wells a year now per rig, compared to maybe 25 historically.
Right. And faster drilling usually means lower cost too, right? Daily variable cost.
Yep, lower cost per foot drilled overall.
And do they think these speed improvements will last?
They use the word sticky. They seem pretty confident these are sustainable gains, not just a one-off thing.
Okay, so faster, stickier drilling efficiency. How did that play out with their spending and activity in Q1?
Well, their actual drilling and completion costs, the D&C costs, were right in line with what they expected for 2025, and they even hinted they might see some more cost concessions later.
So costs on track. But if they're drilling faster.
Right. The drilling team really knocked it out of the park. They spudded 20 wells and rig released 16 in Q1. The plan was only for 12.
Whoa, okay. So they got way ahead on drilling just because of the speed.
Pretty much. They also mentioned their infrastructure spending was heavily weighted to the first half, with most of it hitting in Q1. They said those projects went smoothly, on budget, and are key for supporting margins and flexibility later.
Okay, hold on. If they're drilling that much faster with 2 rigs, but only have 1 frac crew completing wells, wouldn't that create a backlog, a buildup of DUCs?
You got it. That's exactly what happened. Their inventory of drilled but uncompleted wells, the DUCs, rose to 28 by the end of the quarter. The drilling just outpaced the completions.
And they generally don't like having too many DUCs sitting there.
You're right.
Capital tied up.
Correct. So they did make an adjustment in Q1. They saw oil prices were above $70 a barrel for a bit, so they decided to accelerate the completion of 1 4-well pad.
Pull some completions forward to capture the higher price.
Seems like it. So the money for that completion was spent in Q1, but the actual production boost from those wells will mostly show up here in Q2.
Okay, so they drilled more wells than planned and pulled a completion forward. How did that affect the Q1 capital spend relative to their full year budget?
They originally expected Q1 to be their heaviest spending quarter, maybe 35% of the annual budget. They actually ended up spending 38%.
Slightly over budget then.
Well, yes, but they were quick to point out they achieved more work than planned, those extra wells drilled, the accelerated pad, and they still generated positive free cash flow in the quarter.
Okay, that's important context.
Yeah, they even said if you backed up the cost of that accelerated pad, they would have been under their Q1 budget target.
Interesting. So they're efficient, ahead on drilling, building some DUCs. How are they adjusting the plan for the rest of the year now?
This is where that flexibility comes in. To manage the DUCs and keep things balanced, they're actually dropping one of their 2 drilling rigs for 4 months, starting now, May through August.
Dropping a rig. But they just got so much faster. Wouldn't they want to drill even more?
That's the interesting part. They could. They figured if they kept both rigs running at this new pace, they could potentially drill around 65 wells this year. That's way more than the roughly 50 they originally budgeted.
So why slow down?
Prudence, basically.
Yeah.
Given the, shaky macro environment and oil price volatility, they don't want to ramp up activity way beyond their original plan right now. They called it being fast on the brake, slow on the accelerator.
So the efficiency gives them options, but they're choosing discipline. Using the efficiency to stay within the original plan by dropping a rig temporarily.
Exactly. It lets them complete the same number of wells they guided to back in March, stay within the capital budget for the year, all while managing that DUC inventory.
Makes sense.
And they stress they can adjust again if the market tanks or prices really weaken.
Speaking of costs and market factors, did things like tariffs come up? How's that affecting them?
Yeah, tariffs were discussed specifically for OCTG, the casing, and tubulars for wells. They see about a 3% increase in those costs for the rest of the year.
Okay, and how much of the total well cost is OCTG?
Roughly 8% of a typical AFE, the well budget. So, a 25% tariff could theoretically bump the total well cost by maybe 2%, but their strategy helps here. They said they primarily use U.S.-made steel for almost all their tubulars. Since those aren't imported, the tariffs don't really hit them as hard as maybe some peers who use more imported steel.
Ah, okay, so less exposure there. Are they finding savings elsewhere to offset even that small increase?
Yes. They reported savings across other parts of the AFE, other line items. So net, even with slightly higher OCTG prices, they're actually seeing overall well costs decline by low single digits right now.
Wow, so total well costs are still going down despite tariffs.
That's what they're saying, and they think there's more to come. They mentioned these planned pauses in completions, plus the current softness in the oil field service market might let them push through even bigger efficiency steps.
Bigger steps? Like what?
They're planning to start using simfrac operations on some of their multi-well pads soon.
Simfrac. Simultaneous fracking. Tell me more.
Yeah, basically fracking 2 wells at the same time, often kind of zippering the process across 4 wells on a pad. They called it a dollar bill size set change in their cost structure.
A step change, not just incremental.
Right. And interestingly, they haven't even baked the savings from simfrac into their 2025 budget yet. They're being conservative on that.
How much can simfrac save? Time and money.
Quite a bit. On a 4-well pad with those long 15,000-foot laterals, they think it can cut completion time roughly in half, from maybe 25-28 days down to 11-14 days.
Half the time. That's huge. What about dollars?
They estimated around $250,000 saved per well on a pad like that, which works out to about $1 per foot in D&C savings.
$1 a foot is significant.
Definitely. Plus, there are other benefits like less downtime for nearby producing wells during the frac and getting new wells online faster, which pulls that production and revenue forward into 2025.
Okay, simfrac sounds like a potential game changer for their costs. Let's shift gears a bit. How did they frame their asset quality and, the depth of their drilling inventory?
They took a moment to remind everyone that HighPeak was built organically, grassroots leasing, finding prospects, drilling, not through big acquisitions.
Which is less common these days for public E&Ps.
Exactly. And they highlighted their reserve replacement numbers.
How did those look?
Very strong. 345% replacement in 2024, and an average of 400% over the last 3 years. And again, almost all organic growth, which they contrasted with peers.
They also talked profitability compared to peers, right?
Yeah.
Especially at lower oil prices.
Yeah, they did an analysis around a $60 oil price, looking at all-in costs over 3 years, finding development operating costs. They said the average peer is barely profitable at $60.
But HighPeak?
They showed outsized profitability, they said, mainly due to their lower cost structure and higher margin per BOE.
And that comparison included all that infrastructure spending they've done.
Yes, they made that point clearly. Even including the heavy infrastructure investment in their all-in F&D costs, they believe they stack up really well.
And that infrastructure spend should drop off now.
That's the idea. Most of the big build is done, so that capital requirement goes way down, which should really help capital efficiency going forward.
What about recent well results? Anything specific mentioned, like in Borden County?
Yeah, they sounded pleased. They've got 8 wells producing there now, and a new 4-well pad seems to be performing similarly well. They referenced their Q4 2024 wells showing about 20% better 180-day oil production compared to the year before.
And that was across multiple zones.
Yes, Wolfcamp A, Lower Sprayberry, and the Middle Sprayberry.
The Middle Sprayberry. They've been pretty bullish on that zone. Any updates there?
Definitely. They have 2 Middle Sprayberry wells online now, and both are showing break-even prices below $50 oil, actually down in the low $40.
Low $40 break-even. That's impressive.
It is, and they think they have around 200 potential Middle Sprayberry locations in what they call their flat top area. The hope is, as they drill more over the next year, they can prove up similar performance and move most of those 200 locations into that sub-$50 break-even category.
So that would significantly boost their inventory of top-tier wells.
Exactly. Their current count of sub-$50 inventory is around 1,000 wells. Adding potentially 200 from the Middle Sprayberry would be a nice bump. They actually think their sub-$50 inventory could grow over the next couple of years, even while drilling 50 wells a year.
That's quite a statement. Do they think they can really sustain all these efficiency gains, the faster drilling, Simfrac into 2026 and beyond?
They acknowledged it takes working closely with their service partners. They feel the current somewhat softer service market makes it easier to implement things like frac pauses or Simfrac.
But if the market tightens up again,
then they'd need even tighter coordination with vendors. But they sounded optimistic about making these gains sticky, as they put it.
Okay, so let's try and connect all these dots. We've got operational details, costs, assets. What's the bigger picture here for an investor listening to this call?
I think the main message, despite all the market noise and lower oil prices right now, is that HighPeak is intensely focused on improving its own efficiency, driving those operational gains, cutting costs, bringing in things like Simtrack.
And dropping that rig temporarily fits into that. It's not a sign of trouble, but discipline.
That's how they framed it. It's discipline enabled by the efficiency gains. They can hit their original targets with less activity because they're faster. It shows they're being careful with capital in this environment.
What about the balance sheet and capital structure? Any movement there?
Optimizing the capital structure remains a top priority for the year. They repeated their goal of getting to a more normal way, financing likely a high-yield bond plus an RBL once the markets calm down a bit.
And how are they positioned now, debt-wise?
They described their current position as healthy. No near-term debt maturities coming due, and they stressed they're proactively working to strengthen the balance sheet.
Okay. And a big piece of that strengthening plan seems to be free cash flow generation, right?
Absolutely. That was a major theme. Now that the big infrastructure build is mostly behind them, they expect quarterly capital spending to drop significantly.
Well, much lower.
They spent $179 million in Q1. Going forward, they're guiding to more like $100 million to $110 million per quarter.
So CapEx dropping significantly.
While production stays strong, well above 50,000 BOE per day on average for the year.
That difference, lower spending, strong revenue, sounds like it should spin off a lot of cash.
That's the projection. They expect to start generating significant free cash flow basically right now, even before we get into 2026.
And the plan is to use that free cash flow for debt reduction.
Yes. Once they get that new financing structure in place with a large RBL, the bank credit facility based on reserves, they'll have the capacity to use that free cash flow to pay down net debt at par, chipping away at the RBL balance.
Especially in the first couple of years of a typical high-yield bonds no-call period.
Precisely. It gives them flexibility to deleverage quickly using cash flow.
They also mentioned management alignment.
Yeah, just reinforcing that management are significant owners, focused on long-term value, not just short-term market swings. They believe the asset value is strong regardless of current volatility.
And that asset base itself, the deep inventory.
They presented that as a key advantage, having a long runway of good drilling spots when core inventory is getting harder to find elsewhere. And it gives them the flexibility to drill when it makes the most sense for value, not just to meet a production target.
One last thing on the guidance they beat Q1, raised the full year midpoint. Is that just the Q1 beat carrying through?
Mostly, yes. The Q1 outperformance and the efficiencies mean some wells got drilled and completed earlier than planned. So those wells contribute production for more of the year, pulling the average up slightly. They expect the daily rate to average comfortably above the new midpoint, but, there'll be some lumpiness quarter to quarter as pads come online.
Okay, this has been a really thorough breakdown. It feels like the call painted a picture of a company executing well operationally, focused on costs, and setting itself up to use resulting cash flow to fix the balance sheet.
Yeah, it definitely laid out the levers they're pulling and how they see that translating into financial results and options down the road.
All right, let's shift gears completely now. Time for our standard, but very important, this is not financial advice segment.
Absolutely critical disclaimer time.
Couldn't agree more. What follows is purely a thought experiment. Think of it like a hypothetical, maybe overly aggressive pitch you might hear sketched out, based only on the specific points raised in this HighPeak earnings call we just dissected.
Got it. Purely illustrative. Let's hear the outrageous but plausible idea.
Okay, picture this. A highly leveraged long position. Maybe deep in the money call options with an 18 to 24 month expiry, or maybe buying the equity on margin. The core thesis that the market is dramatically underappreciating how quickly HighPeak can pay down debt over that exact 18 to 24 month window.
Okay, so heavily betting on rapid deleveraging. How does that thesis connect back to the call specifics?
It ties together all the threads we discussed. One, they claim a peer-leading cost structure that's getting better thanks to ongoing efficiencies and upcoming Simfrac savings. Two, the massive infrastructure capital drain is largely over. Three, this combination is expected to generate substantial free cash flow starting now.
Right, those are the building blocks they laid out.
Exactly. So the plausible part is grounded in those explicit statements. Lower future CapEx, strong production, projected free cash flow, and the stated plan to pay down debt at par via the RBL. The outrageous part is the leverage involved in the trade idea and the aggressive assumption that the market is totally missing this and will rapidly re-rate the stock as the deleveraging happens.
So it's taking their stated plans and operational advantages at face value and betting big that they execute flawlessly and the market recognizes it quickly. High risk, high potential reward based solely on their narrative.
Precisely. And let me hammer this home one more time. This is absolutely not financial advice. It's just an example of how someone could construct a speculative argument based purely on the information presented in an earnings call.
A mental exercise connecting the company's story to a potential, albeit bold, market interpretation.
Okay, so let's wrap up this deep dive on HighPeak Energy's Q1 2025 earnings call. The key takeaways really boil down to strong Q1 results, driven by impressive operational efficiency gains that are lowering costs and boosting capability.
Right. Also, a disciplined, flexible approach to their drilling and completion plans given the current market conditions. They're not chasing growth blindly.
Plus, they emphasized a robust, high-quality asset base with a deep inventory of economic drilling locations.
And maybe most importantly, they laid out a clear path toward generating significant free cash flow starting now, with the explicit goal of using that cash to optimize their balance sheet and reduce debt.
Understanding these details really gives you a much richer perspective on their strategy and potential than just looking at the headline numbers.
Definitely provides context for how they're navigating the current environment.
And, one final time, the critical reminder. This analysis is purely informational, based on the earnings call content. It is absolutely not investment advice.
Couldn't say it clearer, not advice.
So maybe a final thought to leave you with. In a world of volatile commodity prices, how much of a long-term advantage is it to have a truly top-tier cost structure, deep high-quality inventory, and a demonstrated culture of continuous operational improvement? Does that fundamentally de-risk the business compared to peers, even if the market doesn't fully recognize it today?
Something interesting to chew on.